Hi, this is Nick Weber from Iron Point Private Wealth, giving you our market and wealth update for July 2026. The most useful lesson from the second quarter is that markets can start feeling better before the news does. We had renewed inflation pressure, an energy shock, geopolitical uncertainty, and a Federal Reserve that became less willing to cut interest rates. None of those sound like a recipe for a strong quarter, and yet stocks recovered sharply. So, in the next few minutes, I want to explain why this isn't irrational, why inflation was really telling us two different stories, and what today's interest rates may mean for your cash, bonds, taxes, and retirement plan. Markets do not wait for the headlines to become comfortable. To understand why, let's start with what markets actually price. A common question after a quarter like this is, how can stocks be going up when so much still feels uncertain? The answer is that the market is not a scorecard for how pleasant the world feels today. It is an auction for what investors believe companies may earn in the future. People entered the quarter already expecting plenty of trouble. Stocks had fallen in the first quarter. Inflation, energy, and geopolitical risks were not secrets, but corporate earnings remained strong. Business investment helped offset some consumer weakness, and several feared outcomes did not become as severe as markets had prepared for. That does not mean risk disappeared. It means the future looked a little better than the future already reflected in prices. This is why waiting until everything feels safe can be so expensive. By the time certainty arrives, markets may have already moved. Markets don't need perfect news. They need reality to be better than what investors already feared. The largest threat to that improving picture was inflation, but inflation was telling two different stories. Most people hear one inflation number and understandably ask, are prices finally under control, or are we starting all over again? The honest answer is that one number cannot tell us that. Headline inflation includes everything households buy, including food and energy. Core inflation removes food and energy, not because those expenses do not matter, but because they can jump around so quickly that they can hide the underlying trend. In May, core inflation was 2.9% from a year earlier, while headline inflation was 4.2%. That gap tells us energy was doing a great deal of the short-term damage, but the Fed also raised its inflation projections, so the concern was not imaginary. Think of inflation like a fever. The temperature tells us pressure exists. It does not tell us when the cause is a temporary virus or something that will require longer treatment. For families, both measures matter. Headline inflation affects this month's budget, but the underlying trend affects interest rates, wages, retirement assumptions, and the cost of financing for much longer. Energy can light the match. The real question is whether the fire spreads. That difference explains why the Fed could not respond mechanically. One misconception I hear often is, if the Fed holds rates steady, then why do mortgage rates and bond yields keep moving? The Fed controls only one very short-term interest rate, the overnight price that banks charge one another for money. This influences other rates, but it does not set every rate in the economy. Longer-term rates also reflect expected inflation, economic growth, government borrowing, and the extra return investors demand for lending money for years. During the first half of 2026, the Fed kept its target at 3.5% to 3.75%. Earlier hopes for cuts faded as inflation increased, and some analysts began discussing the possibility of even another hike if pressure persisted, but that was a possibility and not a promise. The Fed was steering a large ship through uncertain water, and turning too quickly could weaken the economy. Of course, waiting too long could allow inflation to spread. The Fed controls one interest rate, not every interest rate, and that brings us to the rate that matters to many portfolios, longer-term Treasury yields. Why should you care that Treasury yields moved higher? Because this affects what you can earn on new bonds, what your existing bonds are worth, and how expensive it is to borrow money. For example, the 10-year Treasury yield increased from 4.19 to 4.44%. That may look like a small change, but on $500,000, it represents roughly $1,250 more for an annual income before taxes when comparing those yields. For retirees, that can create better opportunities to fund future spending without depending entirely on the stock market. For savers, bonds or treasuries that mature may now be reinvested at higher rates. The trade-off is that when yields rise, existing bond prices can temporarily fall, especially longer-term bonds. So this chart is really showing us that income opportunities improved, but borrowing costs and interest rate risk remained elevated. Higher rates are painful for borrowers, but potentially useful for savers and retirees. Here is the practical question. When oil and gasoline jump, is that just painful or does it change the entire economic outlook? Energy hits families quickly. It changes the cost of driving, flying, shipping goods, and operating a business. It also takes a larger share of income from lower income households, so the effect is not evenly distributed. But the lasting consequence depends on two things: how long the shock lasts and how widely it spreads. If oil prices retreat, the inflation effect can fade. If higher transportation and production costs flow into many other prices, and then into wages and expectations, the problem becomes more persistent. That is why we should not overreact to a single monthly category increase, and we should not ignore it either. We watch whether the shock changes consumer spending, corporate margins, inflation expectations, and Fed policy. The first price spike gets the headline. The duration determines the damage. That uncertainty makes the word safe worth examining more carefully. Many people say, I'm keeping this money safe in the bank. But safe from what? Bank cash can be safe from market fluctuation and appropriate for bills, emergencies, or near-term spending, but it may not be safe from inflation and it may not be earning a competitive rate. This slide shows a large gap between the Fed's policy rate and average rates available on some bank money market accounts and CDs. That difference is not automatically bad. The right account depends on access, insurance, taxes, penalties, and purpose, but it is worth knowing what you are giving up. We think of cash as employees with different jobs. Some dollars must be available today, some fund the next few years, some are waiting for an investment decision, and some may be simply sitting idle. The answer is not to chase the highest advertised yield. It is to match the account to the job and understand the trade-offs. Cash is not a strategy until every dollar has a job. So what should a household actually do with all of this information? I would separate the answer into three categories. First, act now on anything with a real clock. Required distributions, estimated taxes, retirement plan contributions, charitable plans, and any cash need coming in the next year or two. Deadlines, not headlines, should create urgency. Second, review decisions that depend on your situation, whether cash is doing the right job, whether bond maturities match upcoming spending, whether a Roth conversion could improve lifetime taxes, and whether your retirement income plan still works under higher inflation or weaker markets. Then third, stay disciplined. A strong quarter is not a reason to chase whatever just performed best. Frightening news is not automatically a reason to sell. The same market can require a different decision for a retiree taking income than for a 40-year-old still saving. The market is the same for everyone. The right planning decision is not. Here is how that becomes real work at Iron Point Private Wealth. The work that matters most often happens after the headline and between the meetings. We are reviewing tax returns to identify decisions that a tax return alone cannot make. A return tells us what happened last year. Planning asks whether realizing income, using charitable strategies, or converting part of an IRA this year could reduce taxes over a lifetime. A Roth conversion is not simply pay tax now or later. It can also affect future required distributions, Medicare premiums, survivor taxes, and what heirs eventually receive. That is why we model it and coordinate with the CPA. We are stress testing retirement income plans. The question is not whether one forecast works, it's whether spending, reserves, Social Security, taxes, and the investment strategy can work through several combinations of inflation, returns, and longevity. We are reviewing cash and bonds by purpose. Which dollars need immediate access, which fund the next few years, which may be sitting in cash because no one has made a deliberate decision. And for business owners, we're looking at the pieces together: business cash flow, retirement plan contributions, personal taxes, liquidity, and the owner's eventual transition. A good idea in one category can create a problem somewhere else if nobody coordinates it. Information tells you what is possible, Planning decides what belongs in your life and what makes sure it gets done. All of that leads to one principle. We pay attention to forecasts, but we do not make a family's future depend on one forecast being right. The energy shock may fade or persist. The Fed may hold, cut, or eventually raise rates. Markets may broaden, or leadership may remain concentrated. Our job is to understand what could change, decide what matters for you, and prepare before a decision becomes urgent. We prepare, we do not predict. Thank you for watching. If this raised a question about your own plan, please reach out. And if you know someone who would find this useful, please feel comfortable sharing it. Thank you again, and goodbye.